Okay. Hi, Matt McAleer, Director of Equity Strategies. April 3rd, just after the close of business. Another volatile week. Like we talked about last week, it would be very unusual, that spike off the bottom last week, if it were to remain strong. That pullback this week was to be expected. Next week becomes very important. Are we able to make a higher low versus 2 Mondays ago? That's the key. Now, we also spoke about different sectors, different industries, different stocks will make higher lows and bottom at different times. Don't fall into the trap at looking purely at the broad indexes as the market. You know, whether utilities or technology or healthcare, or consumer staples bottom ahead of other sectors is important. So we'll keep an eye on that. In our sector rotation strategy, sector alpha, where do we sit? That's an always long strategy. We're long XLK, which is technology, XLV, which is healthcare, and XLP, which is staples. Decent week. All three positive on the trailing 5 days. In terms of our U.S. ETF strategy, still sitting on that 18-19% cash. Anywhere from 16 to 20, let's call it that, per account. We're being a little bit careful, a little bit patient there. Haven't been hurt by not committing money. Tactical, we're up over 30% cash, positioned somewhat fairly defensively, staying patient. Again, I've mentioned now for 3 or 4 weeks in a row, if you chase up days, you're going to get smacked. Try to be comfortable with levels that you want to get long, bid underneath the market, and be sure that you want to own those stocks for 1, 2, 3 years. Great names, traded off heavy here. Plenty of value once we get around the corner here. A lot of clients, a lot of media talk about when the virus is contained, I have money that I want to go into the market with, or the market will rally. That's too easy of an answer. That's too easy of an outlook. When the virus is contained, the market will already be up 20%. That does not mean we're aggressively buying equities. But we have levels circled. We have names circled. We won't be afraid to put capital to work. International is still a headache, and we all have to watch the international equity markets carefully. The ACWX, which is the All-Country World Index ex-US, has held up okay. But don't forget, that had been such a weak relative strength index versus the U.S. that it still isn't making any headway. Internationally, Asia, a little better than Europe. Developed markets, emerging markets, they trade days. One's not outperforming the other. So we have to allocate properly. We have to look at what we want to own. Keep an eye on bonds. You know, at a 0.60 on the 10-year, you know, you've got some attractive dividend yields on the equity side if you can look through this valley. Very important to try to discount some of the bad news that we're seeing, because a portion of that is already in the market. Let's see what next week brings, and we'll be back with you next Friday.
Hi, it's John Mousseau. I am the president and CEO of Cumberland Advisors, and it is Friday, April 3rd, about 6 o'clock. Trying to give you a little bit of an update on the bond market this week. For example, Treasuries had a pretty slow week relative to the volatility that we've seen. 10-year Treasuries probably down around 10 basis points. 30-year Treasuries down around 5 basis points. You're talking about basically 0.6 and 120, respectively. I think the important part is that the lack of volatility is a good thing, because we know the gyrations have been enormous. One of the few times in the last few weeks, we haven't seen a 50 basis point swing in the 10-year bonds. So we like the fact that volatility is a little less. Muni bonds probably gave up about 50 basis points in the longer end, but only about 10 or 15 basis points in the shorter end. I think that's important, and it reflects a couple of different things. It reflects the fact that we know the Federal Reserve has stepped in and helped out the money market funds. That's very good in the short end. We know that the Treasury is going to step in, haven't done it yet, but in the plan done last week, they can buy municipal bonds out through 5 years, and they have to be investment grade or better. That is good. I think that's reflected a little bit in the steepness that we've seen in the municipal bond yield curve, and also a little bit of the back off, especially the 50 basis points in the long end. That is from some more municipal bond funds selling, not nearly at the pace that we saw a couple of weeks ago, where billions were being liquidated. This was more modest, kind of steady, and I think it reflects some of just the retail apprehension about municipal credit in general. Our feeling is that very solid general obligation and essential service revenue bonds represent great value here when you're talking about 3.5% to 4% on these types of bonds with a 30-year Treasury at 120. It's certainly the kind of yield ratios that we never see, and it certainly reflects the economic environment that no one's ever seen before either. So what you really have to do is take a step back and say, what would things look like when you come out of this at the end? And when you come out of this at the end, our feeling is that Treasury yields will rise somewhat, and the tax-free yields, which are pretty distorted right now, will come down somewhat. And that's true of corporate bond yields as well. So at Cumberland, we're trying to extend portfolios somewhat, trying to take advantage of this. It takes a little bit of time. One of the good things is you're starting to see, at least in the muni world, some issuance by issuers. And to the extent they come to market with yields that are clearly higher than they were at the end of February, we think to the extent they get accepted in the market and the deals are sold, it will tend to reprice markets. People will know where prices are, and that's a good thing, because in the middle of the maelstrom a couple weeks ago, no one knew where prices were. So we think the bond market can do okay from here, particularly given the levels and the relative value. And we do think that you're going to get an exit point here. We're going to be back to normal. It'll be a new normal, and we'll be here to try to tell you about it. Thanks a lot. Have a great weekend.